Good evening, everyone. We just have a couple more people joining, so we're just going to give everyone a couple of minutes just to and then we'll get. Okay, so I think we'll get going. So we've plenty on the agenda, so plenty to get through this evening. So we'll just start off. Thanks to everyone for joining this evening. My name's Sarah Connolly, so I'm the marketing manager here at IPF. So great to see so many familiar names on our attendee list this evening. Loads of our existing clients that have been with us for many a year now. I myself am with the company 16 years, and the team of advisors we have here with us today, I think altogether we have 50 years of experience altogether. So you'll have a wealth of knowledge on the call here this evening, all right? So look, just to introduce anyone who maybe isn't familiar with the company, just to let you know who we are. So IPF is an Irish-owned brokerage, okay? So we're actually in business 32 years this year. And we run the payroll facilitated AVC schemes in the public sector. So a lot of you may already be members of these group AVC schemes with us. Now on our team, we have over 70 financial advisors. So again, some of you may have met some of our team before, but they are all experts in public sector benefits. So the experience we have means that we have loads of knowledge on the superannuation benefits that are available to public sector employees. And we work with public sector employees every day to try and get them to a good quality retirement. We have over 30,000 clients in total across the country in places like the HSE, the government departments, the local authorities. And we now have over 1 billion in funds under management for our clients. So these are pots of money that they have grown over the years for their retirement and in their savings. So we're delighted to look after so many of Ireland's public sector. And just if you ever want to have a little look at some more information about us, so some of our clients have left reviews on Trustpilot. So there's a great insight there into some of the experiences some of your colleagues have had in the past as well. So look, here with me this evening, I have an esteemed group of my colleagues here who, as I say, have a wealth of knowledge in some of the information that they're going to give you tonight. So chairing the webinar for us this evening is Ellen McElroy. So Ellen's one of our senior financial planners, but she's also a regional manager. So she's looking after a team of 20 financial advisors day to day. So she's very busy, Ellen. Plenty to be doing and keep you going. Also then on the call today, we have Tom Corcoran and Wendy Thompson, who are both also senior financial planners with the company. So as I say, listen out for all that expert knowledge that they have and some great valuable nuggets of information that they'll be able to give you throughout the evening. Okay, so I hope you all enjoy it. I'm going to hand you over to Ellen McElroy now. We'll talk you through the agenda for the evening.
Thank you, Sarah. It's great to be here, and just to echo what Sarah said, it's great to see so many familiar faces on the registrations and buckets of questions that have come in around the webinar. Just myself and Sarah were chatting earlier. We're doing these webinars since 2010, Sarah, at this stage.
Long time ago.
A long time ago. We used to, book out hotels up and down the country, but we did find that, the webinars were way more effective, and, you can get lots of information at your ease, folks, sitting in the warmth of your own homes. So look, it's been really successful to date, and we're delighted to present again as part of our spring series. Look, the three key objectives for today, guys, it's really to kind of walk you through three simple aspects of your own retirement. So look, what benefits will you receive in retirement? So again, looking at the current situation, what's under the bonnet of that, what's the makeup of that, and is it adequate for you? So again, big key word for tonight, adequacy for you as an individual. And what are the options around these benefits? So before you get to retirement, when you get to retirement, and then moving into retirement. So again, there's three kind of key areas that you need to consider for yourself and indeed your family. And then your own goals for your retirement. So what would you like to see happen for yourself from an individual point of view, for yourself and your spouse, for your family? And everyone's situation is different. So we will talk to you about, I suppose, the financial aspect of it, like what hobbies you want to pursue, your interests, your sense of purpose in retirement. So these are all key questions that you need to be, I suppose, thinking about and asking yourself in the run up to retirement. Look, I just want to set a little bit of a mini agenda for this evening. We're going to, hopefully get all of this packed into an hour, Sarah. So we'll keep an eye on the clock.
We will.
And then Wendy's going to walk us through getting to know your retirement benefits, and then Tom is going to join us and talk to us about making the most of your retirement income, and then I'm going to talk to you around setting goals for your retirement, and then hopefully we'll wrap up by 8 o'clock. Take loads of notes, folks, if you can. But look, Sarah, we will be sending everyone a copy of the slide deck after the seminar. As I said earlier, we've hundreds of questions that have come in. We're going to try and address some or most of them here tonight. You'll probably find the slides will cover a lot of them anyway, but if you feel there's any key questions that weren't answered or you want to explore a little bit more, zip on that QR code, guys, and that will bring you straight through to a link that you can book a glide path appointment. We're going to talk to you a little bit more about the glide path in a minute. Probably at some point, and we say this on all our webinars, you might get that light bulb moment at some part of the evening. So, click on it and really, drive forward the specifics of your own retirement. It's the best way to get the best results for your own retirement. We would encourage everyone to engage in a screening call. You may find that we answer whatever questions you might have in a 5-minute call, and then if you want to move forward for a full financial review with Wendy or Tom or one of our advisors, then absolutely let's move forward with that. We're going to have the chat function off for most of the webinar. And then we let you know when it's off. We have a few little surveys we want you to engage with if you can. And then most importantly, Sarah, we have a little competition. It's €100 all for one voucher. And we will put up a question at the end that we would have covered in the slide deck. So the person who puts the right answer in first into the chat box wins the €100 voucher. So keep those eyes peeled and make your notes. And then finally, thanks to our lovely Sarah Connolly, our marketing manager, who put all the content together. She's one of those whiz kids that, she wrote the script, she produced it, she did the lighting, she did our makeup, did everything, you name it. But we couldn't do anything without Sarah. And as we said, Sarah, you're with IPS since 2008. So a lot of experience. And look, she does stellar work within IPF, championed a new website last year. Take a look at it if you haven't had a chance to explore the website. She's done an absolutely amazing job. And fun fact about Sarah,
oh no.
you didn't think I did this, Sarah, but there you go. Sarah was a champion ballroom dancer when she was 8 years of age. And also Sarah has a significant birthday. It's your 21st, isn't it, Sarah?
That's right. Yeah. Thanks, Madam. Yeah.
And she's off to Vietnam for 3 weeks. So we were saying earlier that if we plan our own retirement properly, we can be like Sarah, heading off on our hollybops and having a great experience. So look, that's kind of our mini agenda for tonight, folks, and I'm going to keep it moving on as much as I can because I am cognizant of time and people with busy schedules, etc. So without further ado, just to kind of get the brains working and, you know, get people thinking about kind of the content for this evening, I want you to just pop in your answers, okay? So look, why save for retirement, folks? And just pop them into the chat function as you go. For every one person retired today, there are 6 working. In 2050, how many people will be working for every one person retired? So if you want to open up the chat function and pop in your answers. So 2, 3, 8, 3. Yeah, lots of answers coming in. 4, 2, 3, 4, 2, 3, 2, 4, other 3, 4. Great. Thanks for the contribution, folks. Actually, the answer is 2. So what does that tell us, folks? So at the minute, we have 6 people working to support every retiree. But what does that tell us about the system? It's going to put more pressure. As we're an ageing population, the demographics is going to be 2 to 1. So 2 workers supporting every retired person by 2050. So what does that tell us? I suppose more of a need to plan, more of a need to take ownership of our own retirement to get exactly what we need and want for ourselves. Life expectancy has greatly increased. How many years do you think the average person is expected to live after they retire? 17, 22, 22, 22. Yeah, great. 12, someone put in 22, 30, 22, 17. And our survey says, Sarah, 22 years. Absolutely. So again, you know, have a look at this again from our own situation. We're living longer and there's going to be less people supporting us in retirement in terms of the workers. So again, what does that tell us? More income for longer, and the pots will have to last us for a greater length of time in retirement. So why save for retirement? Okay, so again, this is really, I suppose, one of the key questions we're going to be asking ourselves. Do I need to? Why do I need to? And what are the benefits to me? So what percentage of your salary will revenue allow you claim tax relief on through pension contributions at age 60? So we have 40, 20, 40, 20, 40%, 40, 40, 50, 50, 40, 40. Okay, so actually, when we reach the age of 60, we have a very generous allowance of our income that we can put towards our pension pots and get some lovely tax relief on it. So actually, the answer is, Sarah? 40%. Perfect. So again, what does that tell us? The older we get, the greater allowance that we get. So it's the revenue recommended amount we should be saving towards our own pension pots. Okay. And then last but not least, what is the average interest rate given on a savings deposit account? 2%, 1%, 1.5%, 0.5%, 1%, 0.8, 2, 1, 2, 1.6, 0.5, 2. So in the post office, Sarah, 0.75%, folks. So again, not far off all of the answers. And then Irish banks on average, 0.25%. So again, what does that tell us for those of us that may have monies on deposit or are coming into money or coming into lump sums? Is it going to serve us well sitting in the post office and in the Irish banks over the long run? So again, we're going to talk a little bit more about that with Tom later in the slide deck. So again, just something to get the juices flowing, get the brains working and getting into the zone of the webinar. So look, thank you for that, folks. Without further ado, I would like to introduce our first speaker, Wendy Thompson. As Sarah says, Wendy is with IPF for 11 years and worked her way up to senior financial planner and also runs one of the sales teams. Wendy would work very closely with financial advisors and the training of advisors and extremely experienced in financial planning. So you're very welcome, Wendy.
Thank you very much. Delighted to be speaking to everyone today.
Yeah, and we've worked very closely for years, Wendy. So I suppose, look, we would be, you know, dealing with clients day in, day out. Look, what is your favourite part of the job currently?
To be honest, it's this part of the financial journey. It's the people that are coming up to retirement, but also in retirement. I love those type of appointments as well.
Yeah.
The reason being, I suppose, normally we meet people that don't know where to start. You know, they don't know what to do. They don't know how to get there. And I think when we're able to put a plan in place and see the hard commitment that people put into these plans, I do understand that. But it coming to fruition at the end is really the rewarding side from my point of view, but also to see my clients benefit from it. So as much as on a Monday morning I'm driving across the M50 and my retired clients are telling me they're abroad in Spain, it means I've done my job right.
Good.
But it may be a little bit envious at the same time.
Oh no, that's wonderful to hear. And again, it's getting those plans to the end of its journey and pulling the trigger on them. It's great. It's very rewarding. Fun fact about Wendy. Wendy has a mini zoo in her house. So Wendy, we have 4 dogs and 3 cats. So I think that's going to probably keep you very busy in retirement.
Yeah, I know a lot of people say about kids being boomerangs and making sure you have money for that in retirement. But I know probably the dog food and cat food is probably more expensive than the food that actually comes into the house. So yeah, we've fussy eaters in our house. So I'll have to make sure that I have enough money for that in retirement.
Absolutely. So get the plan together, Wendy. You know what to do.
Yeah.
Brilliant. Okay, so look, Wendy, we're going to talk about getting to know your retirement benefits. So if we move on to the next slide there, Sarah, please. So what benefits are available? And these will primarily be for the percentage of people on the call here. What is their foundation within the public sector? So do you want to talk us through what these mean? I'm going to just run through questions as I go, folks, because we've hundreds of questions coming in. Amanda from the HSC in Drogheda is asking, what would I be entitled to financially? So can you walk us through what these mean?
Yeah. Okay. So look, for anyone that works in the public sector, there's a deduction in your payslip that entitles you to benefits. And these are the benefits that are underlining. To answer that question, you would get a regular pension in retirement. So that's a regular income paid to you for the rest of your life. Really, that's the thing that as a financial advisor, I would zone in on with my clients. And it's to go back to what Ellen, you were saying with the previous questions. It's making sure that that income is going to sustain the lifestyle that you want in retirement. Yeah. We are living longer. Inflation, we've seen as well, it is an issue. So it's just making sure that you're financially secure and you've got the right level of income to get you there.
Okay.
Yeah, so that answers that question.
So then we have the pensions. That's regular income. That's going to be calculated based on, whichever scheme you're attached to. We're going to talk a little bit more about that. Monica from Galway County Council asks, are you able to take the lump sum monthly or all in one go? What way does that work?
Oh, okay. So to answer that question, you get it in one go when you retire and it's tax-free. Okay. So both the pension and the lump sum are dictated based on when you join service, your salary, and the service that you've accumulated upon retirement. So this is something that we can show you upon retirement or in a consultation what you'll be entitled to.
Okay, and contrary to certain rumours, Wendy, we get this once, we don't get this every year.
Yes.
Is that correct?
Yeah, you don't get it every year. But look, it's a sizable payment. It is very good. You can make good plans with it, which Tom will talk to you a bit later about. But yeah, just planning for it is really the main thing.
Yeah, okay. So again, we're going to get into that a little later in the slide deck. So I suppose then we've got illness benefit, death in service, and spouses and children benefits. So they probably all would kind of link in together in some format. So what are these about, Wendy?
Yeah, I suppose this part is more so about financial security. Okay, so look, none of us know if we're going to get sick. So there is a benefit that if you're out sick from work, there's a benefit payable. So an income until you either return to work or until retirement. There is also another benefit that if you qualify for it, it could be an ill health early retirement pension. Mm-hmm. So again, that would be something discussed with your employer, whether you qualify for that. That's whereby somebody might have to retire early due to ill health.
Okay.
The other benefits then that I suppose a lot of the time, Ellen, when I sit down with people that they're not aware of is that they've got a death in service benefit. So what that is it's a form of life cover. So if you pass away before retirement, there's a lump sum paid to your estate. And I think that's very important to factor in because when you reach retirement, you actually lose that benefit because you get paid a lump sum. So again, I'll talk to you a little bit more about that on later slides, but again, it forms part of your financial plan, and it's very important to understand the underlying benefits first.
Okay. Because there's lots of questions around that. John from Revenue is asking, how do I protect my family when I stop working? Do my benefits extend? So that put that one to bed. So the death in service when you finish will cease. Okay. So again, that's something that we will look at on a review. And then the spouses and children's benefit, just briefly, what is that?
Yeah, that's a pension paid to your spouse for the rest of their days. And then there's a children's pension. So God forbid if you were to pass away and the children are under the age of 17 or 21 in full-time education, they would be entitled to a sixth of the pension. Now, the one thing is that it's capped at 3 children. So you have to pick your favourite. They start replacing each other as they grow up. But again, that comes into a factor that we consider when looking at your life cover coming up to retirement and whether you need it.
Okay, perfect. So this is our main foundation. So we'll establish this on a call. So again, if it's a case you want to find out your own benefits, click on that QR code on each of the slides. Okay, so if we move on then, there's loads of questions around this next slide. Margaret from Waterford City and Coco asks, the classes of pensions and what recruitment days refer to which classes. So again, for those of you on the call here tonight, this is a really important slide to zone in on which one applies to you, I suppose. So do you want to talk us through this, Wendy?
Yeah, I'm going to break them down just to give a little bit of history here, Ellen, in terms of what the PRSI, the difference between the first one and the A1. Okay, so the D1, B1, and C1 class PRSI. That is the creme de la creme of pensions, right? How that differs from the following pensions is you get your pension from one source and it's from the employer. Okay, so I'll have an example of that on the next slide. The retirement age on this contract, in terms of when you're allowed to retire, is age 60. That's the normal retirement age. But then in 1995, the landscape changed when it came to public sector pensions. What they decided to do was they decided to integrate the employer pension with the state pension. Okay, so what did that mean for people? Well, on the second contract here, so they joined after April 6, 1995, but before April 6, 2004. This person would get an employer pension when they left, and they would get the state pension later, which currently is age 66. Okay, so you can see quite a difference, and I'll show you a visual in a moment in terms of the gap there between the income. Now, on that second contract, that person, their normal retirement age is age 60 also. The only difference on the following is that the retirement age changed to 65.
Okay.
So if you want to go at 60 and you joined in 2007, yes, you can, but there would be penalties on your pension. And we'll be able to show you that and how you can plan around that in a meeting.
Okay, and that kind of feeds into kind of the previous survey, Wendy, that, we're an aging population. So hence retirement age is being moved out in line with that. Okay, so we have to work for longer now. And if we retire earlier, we get penalised on this particular contract. Okay.
Exactly. The last contract, probably not many on this contract, coming up to retirement now, but at the same time, the landscape changed quite a lot here. This, again, you get an employer pension when you retire, you get the rest from the state when you're entitled to it. The difference on retirement age on this contract is it's linked to whenever the state pension is. So as I caveat today, Ellen, the state pension is currently age 66. But as we established in previous slides, look, there's pressure there. We need more people working to sustain these state pensions. So the landscape could change in terms of the year or the age that we may qualify for that. So that's something to keep an eye on going forward.
Okay. So for anyone on the call here tonight to tune into their particular dates and what's relevant to them. Okay, so lots of questions in around income, as you said earlier, Wendy, that you would zone in on the income because that's the piece that sustains us all in retirement. Jane from the Department of Justice is unclear what income I get. I have 35 years service. Is this enough? And then we have John from the OPW. I have a gap between retiring at 60 and 66 with the state pension. So this would feed into this slide here, Wendy.
Yeah, exactly. Yeah. So I suppose, look, I got an average, we've got an average salary here, right? I'm going to go through basically what we covered on the last slide, the different schemes, right? We're
Yeah.
using an example of somebody that retired with a 50 grand salary and full service in the public sector. So Ellen, I hope you don't mind. I'm going to pick on you for 2 seconds, right? You're on the creme de la creme pension, the first pension that I mentioned earlier, the D1, B1, C1 class of PRSI. And with your full service, you would retire on an income of 25 grand as a regular income for the rest of your days. Now, as I concluded on the last slide, you would get that from your employer. So for example, if you work for the HSE will pay you 25 grand for the rest of your days. And that's what's going to sustain your lifestyle.
Okay.
What happened then, we mentioned in 95, the landscape changed. They decided to integrate the employer pension with the state pension. And the repercussions of that was that if I decided to retire with the exact same service as Ellen, okay, I would get a pension from my employer of €9,436.
Okay.
So for the exact same work. Where the difference lies is I would get the state pension later, which would bring me up to what Ellen has. I would get a state pension, full state contributory pension is 15,563. That would bring me up to the 25,000.
Okay.
But
So
the problem there lies is that it's not until 66. So if I want to go early, that's where there's a gap.
okay, but in principle, ideally, you should not be any worse off than colleague on your D or your B1 rate of RSI. And this again is assuming full service, so
Yeah.
final salary, half pay, etc. And you can see the direction the incomes are going in terms of the various different schemes. Okay, so we'll move on to the lump sum if that's okay. So we were talking about, how much do we get when we retire tax free. So this is kind of a nice side of the retirement benefits, Wendy, isn't it?
Yeah, look, this is a nice number of money going into the bank account. We don't get this every day in our life, so it's something to look forward to with the hard work that everybody puts in over their working career. So how this works, it's quite a simple calculation, okay? So if you, again, same example, 50 grand salary, full service. If you join service anytime before January 1st, 2013, and you had your full service, you would get 1.5 times your salary as a lump sum, so €75,000. Now, Ellen, what I'd like to highlight here is not everyone's going to have their full service. Okay, so again, let's say the two of us started on the same date, but you worked half time all the way up to retirement. Okay. You would get proportionate. So 37,500 you would be paid into your bank upon retirement.
Okay,
So you can see the difference there of that reduced hour pattern on the lump sum that you get at the end.
okay, and we're going to talk about how we can build up those lump sums and make that back.
Yeah.
And again, assuming I worked 40 years, but I job shared, so I get 20 years full-time equivalent lump sum, if that makes sense.
Yeah.
And then I suppose for anyone on the call here tonight, really important to look at what you're going to actually be on track and what you can build it up to. So, as they say in the London Underground, Wendy, mind the gap.
Mind the gap, yeah. And as well, for a lot of people, if you look at the following columns, the difference, anyone that joined on or after the 1st of January 2013, it's not on the final salary. Okay, it's done on your career average salary. So normally in every occupation, we build our salaries up as we work, and this can have impact. So you can see the difference there of full service. Instead of 75 grand, I'd get 60 grand, and proportionate, if I had half service, it'd be 30 grand. So, speaking to your financial advisor, we can show you how to get you up to what you could have had had you have had full service.
Okay, and it's important to note here as well, Wendy, in terms of the superannuation scheme rules, there's limitations to that, but we have separate revenue rules, so there may
Yeah.
be a little bit more scope on the lump sums, but we can talk to you about that on a financial review. And this is just a few little points on the post-2013 scheme. Elizabeth from Children's Health Ireland is asking, single pension scheme explained, please. So again, you kind of touched on that earlier.
Yeah, look, I suppose it's done on career averaging. So again, going back to what I said there a moment ago, it's not the final salary. Um, I think like the other thing that you have to factor in is the goalpost may change because the normal retirement age is in line with the state pension. So I know prior to COVID, I'm doing the job 11 years. There was talk of 68. It is 66. So it's just something to keep an eye on because that can have bearing on when you decide you want to retire. Look, there's different calculations. It's not a straightforward, but that's where our expertise comes into play, and we can do up some calculations for you to give you an idea in terms of what type of income you're going to have.
Okay, perfect. So look, we'll just keep the slides moving again, just to keep it in within the time frame. Just briefly touch on kind of life cover in retirement. What kind of scenario might someone need life cover once they retire?
Look, there's different reasons, Ellen. I suppose one, somebody might be financially dependent on you. Two, you might want to look after your family financially, or leave something to your estate. But I think the main thing that I come across, and I assume you would say the same, is a lot of people aren't aware that the life cover that they have at work is going to cease upon retirement. Okay.
Yes.
Now, that being said, your needs change as you approach retirement. Okay. The kids, as I said, some of them are boomerangs. They do come back, but we hope that they're not financially dependent. However, we might want to help them out. I know it is harder to get on the career or on the property ladder, and I know some of my clients will want to help out. But again, it's different for everyone. Okay, so in a consultation, what we would normally do is we'd stress test whether there is a need, first of all, and we would ensure as well that if you do take on life cover, that it's within your budget, because you're going to be living on a retirement income, a pension. So we want something that's sustainable. So these are the things that we would look at to see whether there's any need at all.
Yeah, and then just a very brief point from Michael from Social Welfare is asking how to reduce tax implications for his family and advice around low inheritance thresholds. So again, that's something we're coming across a lot recently, Wendy, just with estates and how they're growing and the threshold still being quite low in this country. But again, get the advice from a financial planner around what suits your situation best. Okay, so we'll move on to taxation in retirement, Sarah, please. So Linda from the RSA is asking about taxation on pensions. Siobhan from the HSE, effective tax management. So I suppose, look, talk us through this slide, Wendy. What are the main kind of points from this?
Well, look, we've already got the big win. I've told you about your tax-free lump sum at retirement, so we know about that.
Yeah.
Tom is going to talk to you in a moment about tax-free growth on your AVC and the ARF. So that's something that really can help you in retirement in terms of living off interest. Okay. But the main points that I would say to people is, look, tax doesn't disappear, unfortunately, right? If you're paying tax, it means you're earning, okay, which is good.
Yeah.
But one thing that we look at in the financial planning journey is making sure that you're being tax efficient. And what we would like to see is that you're drawing down your income in a tax efficient manner to give you the best income possible. And how we do that is we look at whether you're entitled to additional tax credits. Okay, whether your cutoff points are in the right manner, if you're married, for example, or whether you should be applying for an annual exemption. Really speaking, Ellen, we can only dictate that until we sit down. But one thing that I would encourage is that if you're married or you have a partner, to factor them into the consultation, because we can give the best advice for the household.
Yeah, and one thing we do see a lot of, Wendy, is that, for a lot of cases that, the taxation is more favourable, because you get your annual exemption limits and then the cut-off points. And a lot of people jump down a tax band because the income is dropping in line with that as well. And even if you're spilling over into the 40% tax bracket, it's a good complaint to have in retirement. It means you have a decent income coming
exactly.
in.
Yeah.
Okay, just moving on to social welfare entitlements. We've loads of questions around this again, Sarah. Just briefly, I don't want to spend too long on this slide, but what's important to consider here, Wendy, very briefly?
Well, I think the main thing is to see if you're entitled to any secondary benefits. A lot of people aren't aware of some of the benefits available to them. Looking myself with so many animals, there's a pet allowance. But there's other things such as carers allowance. I know there's many people in Ireland looking after other individuals. There's living alone allowances. There is aid there for additional allowances. So I would encourage everybody that comes up to retirement to see whether you qualify for any of these. And a great way to check them out is looking at citizensinformation.ie. So we direct you, but I think your advisor as well would certainly have a conversation or point you in the right direction to look.
And we also find your local social welfare office, they're always very helpful, and they'll be able to give you an exact count of where you're at. Okay, so lots of questions around the contributory state pension. What age do I qualify? Do I qualify? What's the criteria?
Yeah, so look, this, as I said, look, this changes from time to time, okay? So look, we're reliant on every budget, whether we need to change what we're saying to all of you. But the state pension is currently paid at age 66 in Ireland. You have to have at least 520 stamps, you'll hear people calling them, okay? So that's your PRSI contributions. But the big change that happened in 2024 was that you were allowed to continue working and not draw down your state pension at age 66, and you can accrue further stamps. So where that really benefits people, Ellen, is, let's say, for example, I lived abroad for a long period of time and I'm just short of that 520.
Okay.
I can qualify for PRSI if I don't draw down my state pension at 66, if I delay it, okay? Now, there's a lot of factors to be considered there. And if you speak to your financial advisor, they can certainly tell you the pros and cons of doing so. The one thing I would say to everybody on today's call, unless you're D or B stamp all your life and had no other employment, I would encourage people to get a PRSI statement from My Welfare, and that will point you in the right direction of how many stamps you have. Sure. There's various different things that can impact that, between not working or working part-time, for example, different things.
Okay, and again, there's lots of different ways you can build that up, but we might talk with Tom around the ARF, and there's a partial stamp that you can gain from drawing income from that, but we'll get to that in a little while. Okay, so Siobhan is asking about effective tax management, including HSE pensions, UK pensions and AVCs. Mary from the Department of Ag is asking around a dormant Irish An Post pension. Victor from the HSE, pension benefits from previous employers. We come across this all the time. So again, the superannuation and public sector pension, great foundation, but you'll often find there's a few little different pots in the background that we need to, bring together.
Yeah. To be honest, more and more I'm coming across this fragmented pension. So you've got pensions kind of everywhere. For the most part, Ellen, people don't know where to start, and that's completely understandable. This is something that we're happy to look at with you. What I would say to anyone that does have secondary pensions, by all means, mention it to your financial advisor, because there's a lot of decisions that need to be made when it comes to these pensions. And the sequencing of the drawdown of these pensions will have bearing on the other pensions. So it's very important that, I suppose, you stress test your options. Does it make sense to amalgamate them? Does it make sense to draw down one before another? But your advisor will be able to explore these options with you. So yeah, by all means, dig them out of the press if you've got your statements and are ignoring them. We can help you with them.
Yeah, and very often we find, Wendy, that sometimes when you uncover these previous pots that actually were okay, we don't need to be doing additional voluntary contributions to top up our pension or taking out other pensions to increase on that, because we have a good stash built up already.
Yeah,
So again,
big
explore
time.
your options and figure out what it is you have at the minute. Okay, so this is one of my favourite slides in the slide deck, our average outgoings in retirement. So this is a snapshot, and this came from the Central Statistics Office, our total average outgoings. So I suppose one thing that we uncovered, Sarah, on the pension summit that we attended in Croke Park, the big word of the day was adequacy. So it's to know your number. What is your number in terms of your income goal in retirement? So this is just a snapshot of total average outgoings. I've a few little ones there that I enjoy, and I'm laughing, Wendy, because the entertainment budget, knowing how you like to socialise and knowing
Yes.
your hobbies, that would give you €13 a day to socialise in retirement. So how would you feel about that, Wendy?
Not great. It wouldn't get me to the Aviva to watch the rugby. That would be my retirement. The other one sticking out to me is the health insurance. I'd love to know what offer they've got, because my health insurance isn't that price. Um, Look, there's different things, there's different expenses for everyone.
Sure.
And I suppose that's something that we can stress test with you in retirement. But I think the main thing, what Ellen was saying, is finding out what your number is so you can have clarity on what your income is going to be in retirement and take away that anxiety.
That's it, exactly. And again, another really useful tool. Mary from the OPW asks, she needs advice around the day-to-day finances in retirement. So if we move on to the next slide, this is a really handy budget calculator. Again, folks, we'll send this out with the slide deck. But just, it's well worth your while to undertake the exercise and just map out what you think you're going to need, what will be your expenses, and throw it all into the pot and see what it throws up, and see, are we on track for that. That's really the biggest advice I can give you here today. Know your number is the big takeaway. Okay, Wendy, any other final tips before we move on to Tom?
No, really, just everyone has taken a step today to join the webinar. This is a taster of, the benefits that you've got. I would highly encourage people to just engage in the screening call. The worst thing that you could be told is that you might need to do something, and if you do, you know what you need to do. It's better than finding out too late.
Indeed, indeed, and as we've always said in IPF, information is key.
Exactly.
Okay, perfect. Okay, Wendy, thank you so much for your contribution and your time, and some really useful advice there, some lovely pointers and tips. And I hope everyone here got a lot from those slides. We're going to move on to Tom. Good evening, Tom.
Hi, Ellen. How you doing? How are you, Wendy?
Good. So, Tom, yourself and myself are sharing our 16th year anniversary this year. Now, not as a married couple, but we both joined IPF the same year, but actually we did get married on the same year, not to each other, mind.
Yeah, not to each other.
We've lots of anniversaries, Tom. So look, you, like similar to Wendy, you've worked your way up to senior financial planner, and as well, you kind of run and train advisors and work very closely with them within IPF. And I suppose, fun fact about you, Tom, you used to be a very proficient drummer in your day. Now, he won't tell me the name of the band, folks, because he doesn't want us looking him up on YouTube. But you always find Tom when he's in a good mood tapping away at his desk out on the floor. But there you go.
Safe to say it wasn't you too, Ellen, or I wouldn't be here.
Exactly. But Tom, I suppose, look, as a financial planner, similar to Wendy, what do you get out of the job, I suppose, from a personal point of view?
So again, some of the things would overlap with Wendy, like, love helping people understand the superannuation scheme, what they're going to get out of it themselves, because, we all hear rumors that, oh, Mary's getting this and so is getting that. Love being able to just deal with the facts and kind of show that to them, and then finding solutions to any gaps. But again, more and more lately, it's actually helping people in times of difficulty. So, you were talking about life cover in retirement, but unfortunately, not everyone makes it to retirement.
Yeah.
So you're helping people out then with life policies or indeed income protection, if people are out sick and that kind of thing. And, I've a couple of clients out at the moment on income protection. So it's a nice thing to do when you're able to pick up the phone and tell them, yeah, look, you're covered where you're getting an income if you're out sick for a period of time, so
Yeah.
that kind of thing.
It's the planning around, what you want, but
Yeah.
also the what ifs is really
What
important.
happens? Yeah. Yeah.
Absolutely. Okay, so look, Tom, we'll keep going.
Mhm.
Again, just cognizant of time. So we're going to talk about making the most of your retirement income.
Sure.
One of the things that, and again, loads and loads of questions in, Raj from the HSE is asking, feasibility of going 5 years early. Helena asks, would increasing the ABCs over the next 3 years be worth it? Patrick from Macy Hospital, how possible is it to retire early? Early retirement is a recurring theme and all the questions coming in. But look, just talk us through the glide path process, and we'll briefly touch on each point.
Yeah.
What does this mean for anyone sitting here tonight?
Okay, so some people will be familiar with this already. What we try and do is at least 5 years out from retirement is to make contact with our clients and tell them what the glide path process is and whether they would like to engage in it. Okay, so what we like to do is from 5 years out is go through a detailed estimate of what pension you're going to get that Wendy mentioned earlier, and what lump sum you're going to get. Okay,
Yeah.
and we stress test that, show you what it's like, and you've got to remember, when you're 5 years out, some people will only have 60 pay slips left to retirement at that stage.
Mhm.
So it's about maybe, utilizing those as best as you can. Okay. So that might mean, as you say, increasing your contributions or maximizing your ABC to obtain the tax relief that's available, and boosting your benefits then for retirement. So it might mean, getting a bigger pot together, or equally, it might mean, as we mentioned earlier, reviewing your existing plans, your existing policies, and making sure stress test those for retirement. Are you going to need them in
Yeah.
retirement? And, if so, what you should do about that.
Yeah, yeah. And one thing that I've learned over the years is that retirement can be, a very busy time. You're making a lot of decisions at the same time. So the
Mm,
more you prep for this and the more far out in advance you know what you're planning for, the easier the process is.
absolutely.
Okay, so we've done
So,
that. We pulled the trigger on the plans.
mm,
We take action. We might need to take action, etc.
yeah.
We get to our retirement day. So what
Yeah.
happens then?
So at retirement then, so what we would try and do as part of the glide path process is at least 6 months before retirement, we would start some paperwork, because there's a lot of paperwork to be done at retirement, and we'll help you through that. So we'll essentially process the claim forms if you haven't got an ABC, preparing anything like that. And then importantly, then we establish your short, medium, and long-term needs in retirement. Okay. So for a lot of people, they're going to receive a tax-free lump sum, usually quite a lot of money, and it might be the first time people have had to deal with this kind of money.
Yeah,
So
yeah.
it's important to, if you're going to spend that, to plan how you're going to spend it and make some plans around that. Okay, and then obviously making any plans for life cover if it's needed in retirement, stress testing the inheritance situation if there is one that we talked about a little bit earlier, and again, like that, possibly putting plans in place around that if needs be.
Yeah, and usually what we find, Tom, is that it's kind of one thing at a time because there's a lot of decisions to be
Yeah.
made to settle the retirement pot, then have the life cover
Mm,
meeting, need it, don't need it, then move on to managing lump sums
lump
and monies
sums.
on deposit, etc. So one decision at
Absolutely.
a time is kind of what we'd advocate, really. Uh,
It's really the only way to do it. You don't want to overload anybody. There's so
yeah,
much going
yeah,
on
yeah,
as you approach retirement.
absolutely.
Um,
And then we move into phase three. So,
mm,
why is there a need to keep reviewing the plans? We've built them up, we've pulled the trigger on the plans, we know where we're
yeah.
at. Why do we need to keep reviewing them?
Well, I suppose like anything, it's a bit like the ABC. We like to engage with our clients annually, if possible, regarding the ABC, and most of it is just stress testing it. In the instance to see, look, is it going to be enough for you there at retirement? But when you do retire, okay, it's just to make sure that what you're taking out, if you have, for example, an approved retirement fund in retirement, that what you're taking as an income is sufficient. If it's meeting your needs, you don't want to be sitting at home afraid to turn the heating on.
Indeed,
Um,
yes.
And again, if you do have a retirement fund, you might have invested it one particular way, let's say when you're 60 or 65, you might want to tweak that in retirement, which I'll talk a little bit about later on when we talk about annuities and that. But again, things change. Life doesn't stop when you retire. So you might need to tweak your plans. You might need to make plans for inheritance. You might have new additions to the family, such as grandchildren that you didn't have when you retired, that kind of thing. And it might just need a bit of guidance on estate planning.
Yes, absolutely. And again, I suppose, if we move on to the next slide, and it was important we spent a little bit of time on that, because that's the whole principle of the glide path, is to move towards retirement, be comfortable, know your options, know your choices, etc. These are just a couple of examples, and we won't spend too long on this, Tom.
No,
Shortfalls in service, why people need to build up these additional pots,
sure.
and we see this every day of the week, depending on occupation, and again, lots of questions in around that. Early retirement is a big one. If we do euro for everyone who told us they wanted to retire early, we'd be very rich, Tom. But I suppose, look, it's important, again, if you're job sharing or reduced hours, that you're getting advice. Just one quick point on this, and we'll move on. Iris from the HSC is asking, how important is my salary in my last year of work, particularly for somebody that might be job sharing or on a 3 or a 4 day week?
Okay, so it's a good question, and again, it's something we come across quite a bit, that people ask us, look, my last year, if I was part-time, for example, should I go back full-time? People tell you that you can get a larger pension for it and that kind of thing. But really, at that stage, it doesn't make an awful lot of difference. If you've been part-time and you want to work the last year as a full-time year. Again, if you engage with us, we'll be able to show you what you can and can't do from the basis of increasing your lump sum, or indeed increasing your pension pot. But importantly, the last year, or indeed, we can actually go back to the last 10 years and look at your overall income over the past 10 years and help possibly inflate your allowable tax-free lump sum at retirement by using ABCs. So that's something we can engage with directly and get more information to Iris for.
Perfect. And so typically what we would see with, if someone's on a 3 or a 4 day week, it's their full-time equivalent salary that would be used, but it's taken away in their service. That's typically
Yes, yeah. So the pension is based on the full-time salary anyway, and it's the service years that are discounted at retirement,
Perfect. Okay, so that's the bit to zone in on, I suppose. Okay, so again, we look at options. Brian from DCC, what measures can I take? ABC's buying back years. So briefly, Tom, what does this mean?
Okay, so when you get the option to purchase back temporary or training years, we'd see that quite a lot with nurses, for example, with training years. Usually makes sense, usually a bit of a no-brainer. Okay, again, you'll get a quote on it. Usually makes very good sense, and it's usually very good value. Okay. If we come on to notional service, that's service that you haven't worked, you haven't been there for, that's something that we would take on a case-by-case basis. So you'll get a quote on it, let's have a look at it and see, does that make sense, okay? It may or may not, okay? The purchase of AVCs, which are additional voluntary contributions, again, you'd think we'd be sitting here saying, look, that's the only show in town, but it's not a silver bullet. It doesn't suit everybody. We'll tell you if it's something you should consider, but equally we'll tell you if it's not. We'll be able to show you why it doesn't make sense, if indeed it doesn't make sense. And then the last thing there, doing nothing, can be quite important too. So quite often, as we mentioned earlier on, there might be other pension pots there. You might have a lot of service and you may not need to do anything. And not having the knowledge of that can actually help quite a lot of people too.
Yeah, so the big takeaway here is just, get advice, explore your options. There's pros and cons to each of these options, but it's to tailor the plan around the individual and what's going to work best for them. Okay, so we're just going to talk briefly on ABCs. How can you build up an ABC? John from the HSC is asking, how do they work? And Pauline as well from the HSC, how are my ABCs working for me? Are they taxable, etc.? So again, just, so we can pay for wages, tax relief, lump sum payments. What does that mean?
Yeah, so like the ABC that we run, the group scheme, it's paid through salary, which makes it really easy. Okay, so deductions are taken at source. Your tax relief is done through payroll. You don't have to go off and do any work. That's all done for you. And the next slide in a second will show you just the benefit of that tax relief at source, how quickly that can accrue for you. You can, though, also make lump sum contributions. that's not done through payroll. We will help you with that independently. And some people do those once a year. Okay, but other people wait until they're closer to retirement and can do it as a last minute lump sum, which I can actually show you on the next screen. I can give you a good real life example of that.
Yeah, very good.
Okay, so this is where some people will hear, oh, so and so retired, and before they retired, they made a last minute lump sum. So this is an easy way to turn 28 grand, or sorry, 20 grand into 28 grand with an AVC. Okay, so this is an example. Somebody had a shortfall of service. So like your part-time person earlier on, Ellen, they weren't going to have the 40 years. They didn't need to go back working their backsides off for the last year or two. Okay, what we found was there was a shortfall of around 20 grand in the tax-free lump sum. Okay, and this person is a higher rate taxpayer. Okay, so they were able to make a lump sum contribution of 20,000 to an AVC. Okay, so let's say you did that today. Tomorrow, then you can go and claim back the tax relief. And if you're a higher rate taxpayer, in this instance, it was 8,000 euros. Okay.
Yeah.
So the 8,000 is sent back into the bank account. All right. So in reality, that's now cost you 12 grand. So then the person retires. So let's say they retired on the 1st of April, for example, and they already have the 8 grand back in tax. Okay. And then they retire and get the 20 grand that they invested originally back tax free. Less charges, etc., that we would go through if that was for you. But it's just a smart way, if you do have a shortfall in service, to make sure you soak up any tax relief that may be available for you.
And this would be specific for just a typical example of a last minute lump sum.
Yeah.
And back to, the tax-free lump sum, mind the gap. What is your gap? And work
Exactly.
backwards from that. So
Exactly.
again, so in terms of ABC, so again, this is going to bump up the tax-free lump sum. Always, always, always advisable for everyone on the call. Any kind of a gap, look at this.
Sure.
There's tax relief you might be leaving on the table if you don't do it. But a lot of our clients would have a more long-term kind of ABC plan because they want to build up their income and their lump sum. So this is an example of how you could build up 100,000 in ABCs. Again, this is another real life example. Tom, you want to quickly walk through this?
So again, we work this out weekly just to show a real life example. This is somebody, in around 50 years of age that met us and decided to save for retirement. Okay. So in the jar you're seeing there, if you go to the bottom, the contribution that they made was a net amount of 67 euros per week. Okay. From the take home pay, it's slightly over 100 euros gross when we add the tax relief into it. So you can see over the 16 years, this person had paid in a little over 56,000 of their own hard earned money. Okay. So if they put that under their pillow, they would have 56,000 in cash. Okay.
Yeah.
Now, because they did it through an AVC, they got tax relief at source added to that 56,000. And over the 16 years, that adds up to about 37.5 grand. Okay. So you're getting money for free. That tax relief is being added to what you can contribute over the years, and you're not taxed on any growth. Okay. So if we look at the top tier there, growth of a little bit over 6 grand over the years. Okay. And that AVC would have seen ups and downs over the years like anything else. And it just shows that a little bit of money over a long time can do quite a lot for you. Building up a fund without any tax at the minute until you get to retirement,
Yeah, and that's a really, really strong feature of, planning through your pension, so similar to say money's on deposit, we know interest rates on deposit is very marginal, but if you're lucky enough to get interest, then there's dirt tax applied. Whereas through a pension vehicle, then tax-free growth, the power of that can be huge, particularly over time. Okay, so keeping it moving. I'm sorry to be rushing you through the slides,
okay.
Tom, but just conscious of time.
I totally get it.
Options with your ABC. So
once you've built up the AVC pot, okay, you have a number of options, okay. And the first option we would normally suggest is we look at the tax-free lump sum, and we usually advise people to take that straight away. So any tax-free money that we can get out of the system usually makes sense to take that, okay. The next option then after that, with the balance, with whatever's left in the pot, you could buy what's called an annuity, which is a pension for life. And we have a screen on that that'll get into a little bit more detail. Okay. But essentially you take your money, give it away and get an income out of it. The second option is the ARF, the Approved Retirement Fund, where similar to an ABC, your money remains invested. Again, it goes up and down in value over the years. But you get to choose, and we have a slide to show you how you can draw down on that. You get to choose what you do with your money, okay? With the annuity, you don't. And then the last option is you could take your money off the table. You could just take the money and run and just pay all the tax back on it. Ordinarily, that doesn't make sense, okay, for most people, but there are examples where we have seen it over the years where somebody has just needed a tax-free lump sum, might be helping a kid out to buy their first property, that kind of thing, and they just need to go in and take it. But ordinarily, that doesn't make sense.
Makes sense, indeed, indeed. Okay, so if we move on to the most, I suppose, realistic examples of how you can draw your money out, the ARF versus the annuity, and the annuity really is just a guaranteed income, a pension paid for the participant's life. Okay, so the differences.
If we start with the annuity, so this is where you take your money and essentially give it away. And our job at that stage is to go around the houses. We're an independent broker and try and get the best deal for you. And the annuity rate is usually dictated by your age at retirement and the current interest rates at the day, so it's a shot at a particular moment in time as to what your annuity rate is. And I have an example in one of the slides to come of what the annuity rate was in 2009 and how that would work for somebody, okay? But you only get one shot at this. And once you give your money to buy an annuity, that's it, it's done, okay? Your money is gone, you get an annual income, but it's not flexible, okay? You can't get more or less out of it. There's no potential for growth. There's a reduced inheritance ability insofar as if you die, the annuity is usually gone unless there's a guaranteed period for a dependent's pension. Okay, again, we can get into more detail on that. What people do like about it is there's no investment risk and it is guaranteed. So it does fill a gap for some people. Okay, if we relate that to the ARF, the Approved Retirement Fund, the income on that is flexible. So from age 61, if you have an ARF, you've got to take out a minimum of 4% per annum. Okay.
Yeah.
But it is flexible. So if you need more money out of that, you can have it. Okay. Your money is still invested. So your money can actually still grow in retirement. And it's important to remember that any growth in an ARF is growing free of tax, unlike anything else. So if you have 100 grand invested in an investment fund and it's growing compared to 100 grand invested in an ARF that's growing, there's no tax on the ARF. There is tax on your investment plan, okay?
Yeah.
In the event of death, there's an inheritance there for your estate, okay? And importantly, with the ARF, if the annuity ever got to be good value, if the annuity ever became attractive, you can buy that at a later age. Okay? And quite often I've had clients in retirement when they get into their 70s, for example, we'll still run the annuity quotes every year, see does it make sense. And it might make sense at some stage because the annuity rate may have got that bit better with age, In the ARF situation, okay, so again, the difference with the annuity, if you've made that decision, you can't opt out of it. With the ARF, if you have the ARF, you can opt into an annuity, or you could split it. You could have a little bit of ARF, a little bit of annuity, okay? Now, Wendy mentioned earlier on the slides about the state pension and how to get it, etc. Some people won't have enough contributions, okay? There is an ability to use the ARF in retirement to contribute towards their state pension in PRSI contributions. So again, we can get into more detail on that on a one-to-one basis. Some of the negatives would be the potential investment risk. So like the AVC over the years, your ARF can go up and down in value, okay? And then there's what's called bomb out risk. So again, because you've got control over your money in retirement with the ARF, some people might decide to take an awful lot of money out over the years. So they might want 20% of their money out each year. That likely is not going to last you a long time if you do that. So there is that risk of bomb out.
Okay, but that's something that we can walk through with our clients, what are the kind of annual needs, etc. Okay, so just moving on, a couple of quick examples, Tom, ARF annuity. This is a real life example of a client that retired in 2009, took the tax-free lump sum, took that off the top of the ABC, and there was a balance of 89,915 left. So just to explain the annuity rate on this, 5%. So this is 5% of the 89,915 would have been set as an income if they had chosen the annuity route.
Yeah, so if they back in 2009, interest rates are a bit higher. So if they had taken the annuity option, they would have been receiving a fixed rate of 5%, approximately 4.5 grand per annum. Okay. And over the years, I think we've worked this out at 15 years there, they would have received a total amount of 67,440, but they wouldn't be getting any extra income in retirement, no options for that. Okay.
Okay.
Now, this particular person decided to go with the approved retirement fund option. And they were invested in a medium risk four. So some of our clients will have done this risk questionnaire. This would be somebody at a level four
Mhm.
bond. Okay. So again, not taking a hell of a lot of risk. They've taken 5% per annum, okay, over the years. And that 89,000 has grown in value. Okay. So they've received a total of a little over 83,000 in income over the years. So almost the same amount that they invested over the 15-year period. And they still had 101,000 left in their fund. Okay. So again, all of that growth is tax free. All of their money is still there. They have the option then to buy an annuity today if it ever made sense. But I don't think somebody with that kind of return and that income over the years would ever want to buy the annuity at this stage.
And it's the power of that 6.65%
Yeah.
over those 15 years, and it's compounding as well. So again,
Compounding, yeah.
just it's the longevity is really important here, Tom, isn't it?
Yeah. And
That's
again, in the event of death, that's going to be left to the estate.
Yes, indeed. One more quick example. This is a more recent example that we put
Mm.
together. Again, a real life example of a client who retired in 2020. Again, took their tax free lump sum and chose to invest the balance in an ARF of 207,000. So we have a shorter space of
Yeah.
time here. Slightly higher risk, Tom.
Mm.
Still not going crazy. It's the higher side of medium risk,
Mm.
and then the regular income was set.
Yeah.
So do you want to just talk us through again
Yeah,
what?
so this person retired June 2020. You might remember we're all in the middle of COVID, don't know what to be doing with ourselves. But this person then took the tax-free lump sum. Again, we'd always recommend that if it's available. Put about 208,000 into the ARF. They had a risk rating of 5. So again, as you say, not going mad. It's on the higher side of medium to high. But the returns speak for themselves. Okay, so they've taken the ARF and they're using it to contribute towards the PRSI, okay, to give them a state pension at age 66. And they've done that over the years. They've drawn a little over 59 grand out of their ARF, okay. And the value as of May last year was actually a little over a quarter million, 258,000. So they've made over, 51 grand in their fund, and they've withdrawn over 59,000 and helped to establish themselves with a state pension in the meantime. So they've done very, very well and still doing well this year. So it's a great example of the possibilities of the ARF.
Yeah, yeah, absolutely. And just managing the asset to,
Yeah.
suit their income needs is really important.
Absolutely. And again, the ongoing management of that in retirement, then when they are in receipt of the state pension age, they might want to take less money out of it.
Yeah, absolutely. Just a couple of quick slides, just I suppose to tee up the investment webinar that we have coming
Yeah.
up in 4 weeks' time. So again, just I suppose deposit rates, as we've seen in the survey at the start of the webinar, the rates continuing to fall over time. So from 5.5% to under 1% in 2025.
Yeah.
I suppose it's to look at the power of that and how it is potentially depleting the value of our money sitting
Mm.
on deposit. If we move on to the
Mm.
next slide then, Tom, Ireland's inflation rate.
Yeah.
Um, this is such a topical area, particularly over the last couple of years, what we've witnessed in terms of the inflationary rate.
Absolutely.
Um,
So,
yeah, I mean, look,
it-
1981, goodness
yeah.
me. Yeah,
So it just shows like that a lot of people, and I mean, government are realizing this, that, there's a lot of cash sitting on deposit. They know themselves, it's just not doing anything. Okay. And inflation is the silent thief. So you can see over the years, okay, if you go back to 1981, inflation at 20%, it's absolutely crazy.
yeah,
But 2023, an inflation rate of 8.5% is really, really high. And and we've all felt that, in the
indeed.
when we go shopping in our weekly shopping, the cost of everything has gone up, and we're still feeling that. Inflation rate is around 1% at the moment, but I would argue it feels higher.
It does. Yes.
It
Yeah.
certainly feels higher than that. And then if you're lucky enough to have some money on deposit or whatever, if your inflation rate is, 8.5%, 6%, 5%, and your bank are giving you 0.75%, the spending power of your money is just decreasing over time. And some people just don't get around to doing it, which is what a lot of people tell us about. It's just, haven't got around to looking at that. If you don't, the next slide will show you what happens to your money. So if you do nothing, the spending power, the value of your money erodes over time. So we're talking about small things like doing your weekly shopping and that kind of thing. But if you look at maybe some of the bigger events, like buying a car now in retirement or any of these kind of things, if you have to change any of the big ticket items, if you've left money on deposit over the years, there's a few examples of the rate of inflation, the cost of that over time. So 50 grand over 10 years at just a 2% inflation rate, which is quite small, has a spending power today of 41,000.
Yes.
The prices of everything else has gone up, but the spending power of your money has come down. So it's a very good argument for maybe considering investing some money, if you're lucky enough to have it there.
Okay.
Now, and we have the investment seminar. We'll go into these in more detail. Okay. So again, it's the same time, different date, 24th of March at 7:00. So again, if you're lucky enough to have a lump sum or you want to build up a lump sum, this is something you should look at. But before that, we just suggested, look, ask yourself, how much do you have available? You can't put all your money away. You might need to keep some there for in case of emergencies. What time frame do you have to invest this money? So think about how long you could leave your money without needing access to it. Okay. What are the primary objectives? So are you saving for college or are you saving for retirement? Again, could be for that. And when will you need to draw an income from your investment, if at all, And then importantly, what access, if any, will you need? So do you need to access money in case of emergency, or can you leave it there untouched for 5 or 10 years? These are the kind of questions to ask yourself before the investment questionnaire or investment webinar, just so you get as much out of that as you can,
Absolutely. Look, loads and loads of lovely little nuggets there, Tom. Thank you so much for your input and the value of that experience, dealing with clients day in, day out. And I suppose the feedback we get from our clients as well is so crucial when we're presenting on these webinars. So really, really appreciate your time. I'm going to fly through these last couple of slides, guys.
Sure.
And I suppose setting goals for your retirement, just kind of more to kind of process some things to be thinking about from your own situation. So this is a graphic that I really like. So this is me flying my little plane towards retirement, and my plane is packed full of luggage, which would include my mortgage, my creche fees, my school fees, my cost of raising kids fighting in the back, etc. Or in Wendy's example, it's the cats and dogs fighting in the back of the plane. Hopefully along the way, my kids might take the hint at some point and parachute off my plane and my luggage gets a little bit lighter, but I still might want the same lifestyle that I've grown accustomed to over my working life, and a few little nice things available to me in my suitcase. But look, this just demonstrates what kind of a journey do I want? Do I want a smooth journey with very little turbulence along the way and landing exactly where I want at retirement? So again, looking at that figure, my own figure for retirement, what income do I want? Is it adequate? Adequacy is the word of the day, folks. Or do I want a very uncertain journey with a lot of bumps along the way, and then I land way off target, and the uncertainty, it really compounds and makes the journey to retirement quite difficult. So look, Sarah, if we move on, I suppose, look, again, back to the pension summit that we attended in Croke Park, the retirement number is really important. And if it's one thing I can ask you to take away from today, what kind of an income do I want for myself? So, again, what we're advocating with clients is that, modest income is 30% of your working income. Your basic needs are covered, but you've limited money left over for your non-essentials. And your non-essentials could be going out, having a cup of coffee, going for dinner once a week. Moderate income, 50% of your working income, which is, I suppose, our benchmark in the public sector with max service. 50% is the best we can arrive at without any additional. You have more flexibility and a small financial safety net should the unexpected occur. Or do we want to be comfortable? So 70% of our working income, which is in line with, I suppose, a revenue recommendation, which is typically about, 2/3 our salary, more financial freedom, afford some luxuries to enjoy in your retirement, holiday once a year, weekend away, going for dinner, not having to worry to keep the lights on. So where do you want to land, folks? What's your figure? What's your retirement number? That's something I'd ask you all to think about. And a really, really good paper, the Retirement Living Standards. I would encourage you all to read it and look at and see what is it I would like to see for myself. So I'm going to open the chat box here, guys, one last time. And fastest finger first. What does a comfortable retirement look like to you? So just pop your answers into the chat box. 70%, 70%, 50%, 70%, 50, 70, 70, 60 to 70, 70, 50, 70, 50, 70. Yeah, we're getting a lot of 70s, Sarah. Yeah. And I suppose this survey that we're going to talk through now was done by Business World.ie in conjunction with Standard Life. And these were, I suppose, the top 5 areas that were important to people that felt a comfortable retirement might include all of these. 70% of income, most of you are saying to me on the chat box, which again says to me that a financial plan is definitely something that you should be looking at if it's a case that, we're in the public sector space where the best we can come out with is 50% salary. Have a look at, I suppose, financial comfort, doing the things we want to do. So having those little extras. It's something myself and Wendy discuss all the time. When we're on holidays or at the weekends, we spend more money because we have more free time. So, when we retire, that might also be the case. So doing the things we want to do. Financial security, covering the essentials. As we all know, the cost of living is increasingly going up, covering the basics. We're spending a lot more time at home. What expenses do we want to cover? Will our kids, will our mortgage be gone at that point? Looking after the family financially. So having the ability to, give children money, bring them on holiday. What does that mean to you as an individual? Another big one was, I suppose, looking at where you want to spend your time, enjoying hobbies. We see a lot of clients going back to college, educating themselves, re-educating themselves. And a big one was my overall sense of purpose. Because in a lot of cases we find our identity is wrapped up in our occupation. So once that stops, we need to think about how do we fill our day, where do we get our sense of purpose from, and other things that you might want to do. And then the flip side of that survey was bad retirement. The top 2 answers were poor physical health, and being financially strapped. So again, financial planning is a huge, huge part. It's not the be all and end all of retirement. There's lots of other things we need to consider. But 6 bits of advice before we wrap up. So plan. What will you need and when will you need it? So what's my goal? What's the age? What is my number? What's my target income? Then do the little gathering. The hunter and gatherer, as Wendy and Tom advocated for. Find out what pensions you have, what's there, what assets do we have, what inheritance, cash, everything all is thrown into the pot to determine how comfortable you're going to be in retirement, and then assess. What can you do? Do I need to take action, pull the trigger on a plan? What can I do between now and retirement? Can I maximise on this? There's lots of lovely features and benefits. It's not particularly the reason to do it, but it can give you a helping hand along the way, like the tax relief, like the tax-free growth, like that compound interest we spoke about, and then use your buckets. So your short-term needs, your medium-term needs, your long-term needs, and then review annually. As Tom says, even when we retire, review them into retirement. Things change all the time. And what is our legacy? Who do you want to look after before retirement, in retirement, and then after we pass away? So again, future-proof the assets that you spent your whole life building up, and look after the people that you want to look after. So we're nearly at the end, folks. This is our lovely Sash on the Retirement Help Desk. And again, so the typical queries we would get in, so there's no cost to reviews or sitting down and having a look at your own situation in retirement, pick up the phone, ask the question. You'll be referred to your financial planner or a financial planner, and these are the typical questions that we would get day in, day out from our retired clients. And we'd like to think very happily retired clients too. And then I suppose before we wrap up, Sarah, we want to ask our questions. So pop your answers in the chat box, folks. What was Ireland's rate of inflation in the year 1981?
Loads of answers coming in
Oh,
already.
they're very
Rosie, this
quick.
is Ellen.
Fastest fingers first, honest to God, yeah. Fabulous. So do we have a winner there, Sarah?
Oh, let me see. Okay, so I think the first one was Roy Thompson. So well done, Roy. We'll get your voucher out to you tomorrow. Well done.
Done, Roy. Congratulations. So happy spending with your One for All voucher. So I think we're nearly at the end there, Sarah. So I suppose, thank you, Roy. Happy spending. I suppose, look, what happens next, folks? There's your QR code. If you've had that light bulb moment, you want to find out more, I would strongly, strongly encourage you that you click on that code, book in for your 5-minute screening call with a qualified financial advisor. They'll very quickly tell you whether you need to move forward for a full review. If you're an existing client, definitely let's sit down, look at the plan, review, make sure you're on track for what you need. And my thanks to Wendy Thompson, Tom Corcoran and Sarah Connolly for the content this evening and your really, really wonderful contribution and all that experience here on the webinar. And last but not least, I want to thank all of you for attending and taking the time out for what can be really, really important webinars to get you thinking and making those key decisions. And we all wish you a long and happy retirement for whenever that day may come. And good night and God bless. And thank you very much for attending.
Thank you.
Thanks, folks. Thanks,
Thanks,
Ellen.
Ellen.